Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duke Ong with Tri-City Equity Group. On this episode of the educational series, we'll be talking about the syndication offering as it relates to multifamily. With me is my co-host, Vince Giddings.
Hey, Duke. Excited to keep going with this education series. We got an awesome topic today. It's going to be the offering basics, like what's the terminology, what's the jargon. A lot of people get caught up on not knowing the definitions of stuff or what normal looks like when they're getting these offering packages. So we're going to go through and list the different, the main key points on fee structures and company structures, and maybe some of the documents that you're going to see when you start getting into this, the world of syndication and JVs and stuff like that. So going right into it, what are the different fees that are involved in a syndication?
Well, there are a variety of fees typically involved in a syndication. As a limited partner or LP, you want to be aware of what the sponsors charge and compare that to market norms. The first type of fee is the acquisition fee. This is the compensation the sponsor receives for the time and effort and skills needed to obtain the investment opportunity. And usually this can range from 1% to 3%. The second type of fee is the asset management fee. This is payment for the management of the asset apart from the day-to-day property management fee. And typically this is based on the amount of the capital raise. And this can vary from 1% to 2% and can be paid quarterly or annually. And the third type of fee is the refinance or disposition fee. The sponsor may be entitled to a percentage of the refinance or sale proceeds for the effort in structuring and negotiating that capital event. And this can vary between 1% and 2%. Once all the capital is returned, the excess profit is then split between the LP and GP according to the schedule, such as 70-30 or 80-20.
Yep. And another note for the asset management fee is, I know you mentioned the capital raise. I've also seen it where it's on the loan amount as well. So just pay attention to what they're saying in that structure in the PPM, what the fee structures are, what ones they are charging. But these are just the kind of the industry norms of what we're seeing. These 1% to 3% fees that the management team, the GP, is getting for their sweat equity. They're getting, this is their, the funds that they're going to be, eating off of as they work through this deal. All right. So the next one, as you already mentioned a little bit of this, what kind of profit splits are normally involved? What do those normally look like?
There are numerous ways to structure a deal. And here's a few options. The first type is a straight equity split. So this can vary from 60-40 to 80-20. And what the 80-20 means is that the investor will receive their prorated share of 80% of the excess profit after the deal pays out all the financial obligations. And this can apply to both the cash flow throughout the project and capital events such as a refinance or sale. And the second type of profit split is a preferred return, also known as a pref, and then an equity split after that. So in this case, the investor will receive a preferred return before the sponsor is paid. And then if the investment does not hit this return, the balance can be accrued until the payment is caught up. Once that happens, the remaining profit is split according to the terms spelled out in the legal docs. So like, for example, 70-30 or 80-20. And then the third type of split is called a waterfall. And there are many varieties of this. So there's something called a hurdle that when achieved would then change the split. So for example, you can have a waterfall of 8%, 10%, and 15%, meaning that once each of those targets is achieved, the split then changes to become more favorable to the sponsor. So for example, at 8%, it might be 80-20, and then at 10% it might be 70-30, and at 15% it might be 50-50. So you want to be careful with these because this can be an example of where fees become too favorable to the sponsor. You might see this in a lot of the more experienced sponsors with many units under the belt, and so they can charge this because of their many years of experience. So it's not necessarily bad, but you just want to be careful with those. And one point about this is that although the splits are important, the most important thing to evaluate is the overall return on the investment, which depends more on the operator and the business plan rather than the split. So don't put too much weight on the splits, as this is just one of many factors to consider as an LP. So to ensure that your investment is secure, you want to verify that the returns occur throughout the life of the investment and not the majority upon sale. And this is because many assumptions are made upon the exit, and it's difficult to predict what the market would be like 5 to 7 years from now.
And a lot of what you're talking about is if you're an investor, understanding what your risk profile is, because that'll weigh heavy on what deals you go into when the sponsor is sending you a deal, and be able to assess that deal on where most of that return is coming from. Is it going to be coming from cash flow, or is it going to be coming from that sale? And you need to know this, and we'll get to this in detail in a future lesson, but it's very important because on a spreadsheet, I can make any deal look like an 18% IRR with a 2x equity multiple, and it looks great. It's a home run. But then when we break down the actual cash flows of that deal, it could be that you're not getting any cash flow for 5 years, and you're banking your entire investment on a big payday at the end at sale, which isn't bad. There's people that focus on distressed properties. That's their business plan. But you need to be an astute investor and be able to recognize that that's what their business plan is, and be able to ask those questions. Ideally, what most sponsors try to do is get 50% of the return coming from cash flow, and then the rest of the 50% coming from a capital event, either refinance or sale at the end of that business plan. That's the ideal split. So you're able to lower the risk with some predictable cash flow, and then still have enough payday at the end to get that nice chunk of at the sale. So that was an important point there of just as you need to understand what your risk profile is. Another one of these fees you want to look out for and always have the question of is the alignment of interest. You want to make sure that the sponsor is incentivized to perform or even outperform the business plan that they're stating, and they're incentivized to do so. So if the splits or the fees weigh heavily and the splits weigh heavily on them receiving something, even if they're not performing that well, then that might be something you want to question. So that is some 2 points I want to bring up. And then just a side note in the back here, I think the most common split or structure in syndication is going to be a 70-30 split with an 8% pref. That is like the most common structure that we see. Again, this is creative world. We can do whatever we want to structure a deal, but that is the most common. All right. So what time frame can an investor expect?
Well, most multifamily syndications are illiquid and expect their capital to be tied up for anywhere between 3 to 7 years. And this can vary widely, as sometimes unsolicited offers can come in, and that will lead to an early exit. You might be able to get a supplemental loan, or if there are unfavorable market conditions, you might hold on to the property longer until it's a favorable exit. So be sure that your investment goals align with those of the sponsor.
Exactly. And then two notes on that is the sponsor should be vetting you just as you're vetting them. You're not you're joining a partnership with each other for the next could be 3 to 10 years. So they're going to vet you just as much as you should be vetting them. And one of the things is they're going to ask you, can you afford to lose this money? Are you going to be hurting if something happens in the next 2 years and we might need to extend the business plan out? Maybe we're going to do a 5-year hold, maybe it'd be a 7-year hold because the market changed. Like right now we're going through coronavirus. There's probably a lot of people that were looking to exit this summer and made the smart decision to let's hold off and maybe push it off a year or two. Because that's the best thing to do for our investors in the business plan. So they're going to be asking you, is this money that, you're going to be calling me 6 months from now because, this was your emergency fund. If that's the case, they shouldn't be taking that money from you, and nothing against you, but that'd be a smart decision on both parties. So the timeline's important. Really look back when you're looking at your budget and your investment. Is this money that I can be completely okay with, not seeing for a very extended period of time, because it is illiquid is the name here. It's not like a stock where, something happens in life and you can go, pull 20K out of ETFs and go, fix a roof or something on your personal house or fix a car. This is not that kind of vehicle. All right, next question. So let's talk about operations. What type of business plans are there in the multifamily space?
Well, these can vary from a turnkey, buy and hold, A-class, to light to moderate value add, all the way to ground up development. So generally, the more construction that's required, the more risk is involved. So you can imagine that ground up development is much higher risk than a turnkey A-class large multifamily asset. So this is actually why we target light to medium value add assets, because it provides a blended approach towards risk. And the beauty of multifamily is that the value is based on net operating income, or NOI. Therefore, more efficient operations and increased NOI directly leads to increased value upon exit. And this can be done either by increasing revenue through raised rents to market value, or decreasing expenses through utility conservation and build back. So it's important to verify that the sponsor's projections are in line with the market and that the pro forma is not too aggressive.
Got it. No comments on that one. I think you wrapped that one up pretty good. What questions should an investor consider when it comes to the property manager?
So there are many different ways that the property management can be. It can be either third party, or it can be folded in and vertically integrated into the sponsorship team. So you want to verify the track record of the property manager, and you want to make sure that their experience matches that of the asset. So for example, if you're buying a C-class asset, you want to make sure that property manager has experience managing C-class assets in that submarket.
Exactly. And the other side of it would be, you don't want a property manager that traditionally does single family homes, all of a sudden take on a 50 unit C-class apartment building. They're not going to have the systems or the experience to be able to handle a project like that. So again, that's part of the sponsors to find that person, but the investor should ask that question again to do their due diligence on the sponsorship team. What type of exit strategies are there?
Well, as an LP, you want to make sure there are multiple exit strategies and contingency plans. So these can include refinancing after stabilization, selling after stabilization, and long-term hold. So this is especially important in down markets. One important metric to consider is the exit cap rate, or the reversion cap rate, which is the cap rate that the sponsor used to underwrite the final sale price. And this is mostly speculative, but a general rule of thumb for conservative underwriting is around a 1% premium to the current market cap rate. And however, this can vary depending on asset class and location and market conditions. And this may seem counterintuitive, but a lower cap rate means that the market improved, while a higher cap rate means that the market worsened. This is because it will take a higher cap rate for a reasonably sophisticated investor to buy the deal, given the inherent risks involved. Therefore, assuming a higher cap rate at exit means that the sponsor is assuming the market will be worse. So if the deal still works with those assumptions, then that's a solid deal.
There's some good points on the cap rate. And this is not something that we expect newer investors or even seasoned investors, sophisticated investors, to really understand it. It takes a lot of time to visualize what a cap rate is, and then also when applying it to acquisition and exit in different sections of a business plan. To your point, when you said the reversion cap rate, or it's also called the terminal cap rate, right? The capitalization rate that's going to be applied to that property at that exit event. The best thing to do would be to, if we're planning the market's a 6 cap, we're going to say it's a 7 cap in all of our assumptions in all of our business plans, because we're going to be conservative in our underwriting, and we're going to plan for the worst and say the market's going to be worse than it is right now. And if the deal still works with us saying that we're going to buy it as a 6 and we're going to sell it as a 7 or 8 even, then that's a really good sign for us and the business plan and the model or in this property to show, because 6 to 8 is a pretty big jump up. The market has to worsen a good amount. And if the deal still works with going up 200 basis points, then we're looking at a pretty solid deal. Okay, so the next question: what general key performance indicators, also known as KPIs, should an investor look for in a deal?
There are few metrics to consider when evaluating opportunities. One is positive cash flow from day one. And this is important because you'll need that to sustain any financial storms like the one we're going through right now with the coronavirus. Two is sufficient reserves to cover all the working capital and capital expenditures needed to execute the business plan. And three is favorable loan terms with a long term. And this is especially important because you don't want to be stuck having to refinance or sell in a down market.
Yep. And so for this one, I think the biggest one that people or people underwriting they overlook is those that working capital up front. CapEx, the capital expenditures. That's usually a pretty easy one. They find some stuff wrong with the property. They go get bids from contractors. They have a solid number. They put it in their underwriting. They're good to move forward. But working capital is a little harder, right? Because you have your operating expenses, and then the management team kind of has to sit down and say, okay, how many months of operating expenses should we hold back in reserve? Because it's a balance there. Because ideally, you'd be like, oh, well, as much as possible. But you can't, it's hard to do that because then now you have dead equity. You have money that you're raising or that you're coming to the table that's not really sitting anywhere. It's just sitting in a checking account. And what that's going to do is that's going to dilute the returns of the deal. So you're going to trade security for the returns. So it is important to have working capital, but you don't want to just arbitrarily throw, $100,000 in a savings account for your rainy day fund, because that $100,000 is no longer working for you in the deal. And that's what we're trying to do. We're trying to invest money to get a return. Well, if I had put $100,000 in a savings account as a rainy day fund for a deal, that money's not working. So there's a balance there that operators really need to sit down, and we do. It takes time to sit down there and say, how many months do we need? How stable is the property? What's our turnover expected to be like in the first phase, first few quarters of acquisition? What does that look like? And we kind of come up with a few scenarios, balance them out, and pick a number of what we want to have as the working capital. And the long-term, the loan terms, and we'll go into this in a later thing too, but you want favorable loan terms, not just the length, right? So a 5-year wouldn't be as favorable as a 10-year because you don't have as much flexibility. But also things like the yield maintenance or prepayment penalty. If you have a 4% prepayment penalty, it really ties our hands on flexibility. If something changes in the market and we want to refinance the deal to give better loan terms, we'd have to pay a 4% prepayment penalty. Where if we negotiated that up front and we got low prepayment penalty or no prepayment penalty from the lender, that gives us a tremendous amount of flexibility in terms of exit strategies. We could refinance it. We could sell it. Things like that. We can get like supplemental loans. So having that prepayment penalty down as low as possible is really a benefit to have. Great. So can you tell me more about the legal documents involved?
All right. So the legal documents consist of the operating agreement, or OA, subscription agreement, or SA, and the private placement memorandum, or PPM. So the operating agreement spells out the structure of the business. The subscription agreement describes the investor's involvement in the company, and the PPM is used when securities are sold under an exemption from SEC registration, and typically it's either 506B or 506C. Describes the sponsorship entity, terms of the offering, and risks of the investment. Be sure to read and understand the entire set of documents, even though it's lengthy, because these govern the parameters of the project. And regarding the PPM, some questions to consider are, is it possible to sell my interest? What happens in a capital call event? What happens to my interest when either the sponsor or I pass away? What are voting rights? If the sponsor underperforms significantly, can they be removed? What is the compensation structure? What are the loan terms? And what is the distribution schedule? Of course, there's other questions, but those are just a few to kind of get you started.
Yeah, and with this one, a lot of times, a lot of investors maybe just, when am I going to get paid? What's the distribution schedule? I don't really care about anything else. But there are things that you're going to want to know. Like I said, if something significant happens in your life and you need to sell, the PPM might say you might need to hold on your shares. No, everything's illiquid for everybody for a year. And that's very common. You can't do anything for the first 12 months. After that first 12 months, then you can sell your shares to either another member or go out and find somebody to buy your shares in that company. But that might be something that you need to look into, is how soon can I get out of this if the worst case happens and I need to get out of this deal. Voting rights are very important too. If you have a sponsorship team that is non-performing, at what point can the silent partners, the limited partners, band together and vote to get them out? And what is the percentage they need in order to pass a vote to have a management team removed or a member removed? So lots of stuff. If you need help with any of these things, I'd probably get a lawyer. Pay a lawyer a couple hours that walk through these with you, or somebody that has been an LP before to help you read these documents. I would not just go at it alone. It's hundreds of pages of information, all of it fairly important. So this is something if you're not familiar with it, definitely get assistance your first time around until you know what to look for. How should an investor consider an opportunity in the context of their investment plan?
All right, so you want to consider your goals and stage in your investment career. Someone who's looking for growth may differ in their risk tolerance than another investor who's looking for capital preservation. Just because a deal looks great does not mean it's great for you. So it's wise to verify that the business plan fits your portfolio allocation and where you're at in your career. So a few questions to consider here include, what is the minimum investment amount? How long will the funds be tied up for? How likely is the sponsor able to execute on the business plan? Does the vision for the project match my investment goals? How do I feel about the sponsor? And how comfortable am I with the risk disclosed in the PPM?
Exactly. I'm going back to what we said earlier about that, your risk profile. What are you comfortable with? And a lot of this goes into just your personal, disposition. If you're going to be really upset about losing $100 or $1,000, then you're going to want a lower risk investment. On the other hand, if you're like, let's go to the craps table and let's put it all out there, and you have a really high risk tolerance, you might want to go find yourself an investment for that. This is where you really want to know those structures of what a pref is and what the split is. Because for those that are a little bit more risk adverse, you're going to want to position yourself into a deal that offers a good preferred return. Because the preferred return gets paid before anybody else gets paid. Before the sponsor gets paid, before the other investors get paid, you get paid first. So if some deals are combined, the pref is combined with the regular split, but in some deals they offer two different kinds of shares. Like for the last deal we did, we did A1 and A2 share, where A1 is they just get a pref, and the A2 is they get the split. And other sponsors do things similar, but it's all about meeting. The sponsorship should just offer something that the investors are looking for, and solve the problems that they're having. So if you're a little bit more risk adverse, then look for deals that have higher preferred returns, because they're going to be the ones that get paid first on a deal. And if you're a little bit more have a higher risk tolerance, then you're going to want to maybe look for deals with big upside projects, distressed projects, reposition, stuff like that, that have the opportunity to have a big sale at the end from a reposition being successful.
And to the point about the liquidity and the fact that these offerings tend to be illiquid, I have a theory that investments that are more liquid, like for example, trading stocks and ETFs, are higher volatility. Yeah. So the lack of liquidity in real estate is actually a positive, because it leads to price stability and principal protection.
You might have something on that. People can't get it out as quickly when they start panicking and start making emotionally rational decisions. They have to, it takes time. So maybe it's time for, rational and level minds to come and level everything. I don't know. That's a good theory.
Yeah. All right. So as we wrap this up, if you are interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and more. If you found value in this podcast, please subscribe and give us a rating and review on Apple Podcasts or Stitcher. And if you know anyone else who might resonate with today's podcast, please share the episode with them. See you next time.
All right. See you, dude.